The next two methods of depreciation are accelerated methods of depreciation, where we're going to take more depreciation in the early years where we have the most benefit of using that asset, and less depreciation in later years when the asset might be down for repairs, for example. So we'll get less utility out of those assets, so we're going to depreciate less in the later years. The first of the two methods that we're going to look at is the sum of the year's digits. In this method, we're going to have decreasing depreciation charges based on a decreasing fraction of a depreciable cost. So the fraction is determined by taking each individual year and dividing by a base. And the base is simply adding up all of the years of the asset. So in this case, we've got 5 years for the asset. So we're going to add 1 plus 2 plus 3 plus 4 plus 5. The base is always going to be determined by taking the useful life and adding up each of those years to get to your total. Now that we've computed the base, we can work on the calculation of depreciation for each year. In the first year, we're going to take the most depreciation. We're going to take 5 out of 15, and we're going to multiply that by our base of 126,000, which again is the cost minus the salvage. And we're going to multiply that by our partial year. So we're going to have 5 months from August 1st to December 31st out of 12. So finally, for that first year, we're going to take each individual amount and multiply across. So the first year, we're going to have depreciation expense of $17,500. Now in that first year we took 5 over 15ths, but we only did that for partial year. So we need to complete that year in year 2. So I'm still going to use, for part of the year, the 5 over 15 multiplied by that base. And the partial year then would be the remaining part of that 12 months. So we already did 5 months, so we're going to do 7 out of 12 months. And we'll multiply that across. Now we're going to complete year 2 by, instead of multiplying by 5 over 15, we're going to move down to 4 over 15. So we're going to decrease our rate as we go through the asset's useful life. So 4 out of 15 is our ratio. Still the same base, which will carry all the way through. And we did 7 out of 12 months before, so now we're going to finish off with the remaining part of that year, so it'll be 5 out of 12 months. So I can total that up on the side. Year 2's depreciation would be $38,500. And if we move on to the next year, we're going to still continue to use that 4 over 15 for a partial year. And we're going to use 7 out of 12 months. And then we'll move on to 3 out of 15. And we'll complete that year with 5 months. And so we'll have $10,500. So in year 3, we'll have depreciation of $19,600 plus the $10,500. I've completed the remaining part of the schedule following that same pattern. And I've added up all of the depreciation amounts per year, and you can see that I've worked back to the base, which is $126,000. And we've got partial years at the first year and the last year, and you can see that there is a decreasing pattern of depreciation each year. The second method of accelerated depreciation is the double declining balance. The straight line method is simply taking 1 over the useful life. So we take 1/5 and depreciate it each year when we use straight line. And with double declining then, we're going to double that rate. So 20% multiplied by 2. So our double declining rate is going to be 40%. Now our depreciable base for the double declining balance is different than the base that we've used in all of the other methods. Here we're going to use our carrying value. Originally our carrying value is our original cost, $150,000. So our annual expense is going to be our depreciable base multiplied by the rate. We'll end up at $60,000. We've got to adjust that for partial year, so the first year is going to be multiplied by 5 over 12. In the next year, we're going to take our carrying amount And that's going to be our original value subtracting the depreciation expense for year 1. So our new carrying value at the beginning of year 2 is $125,000. We multiply that by 40% to arrive at our depreciation, and so we'll have $50,000 for year 2. And we'll follow that pattern, taking our carrying amount from the prior year, subtracting the depreciation expense, and multiplying that across. What we need to be careful with in the double declining balance method is that we don't depreciate too much. We don't have a natural stopping point for depreciating the asset using this method. So you can see that if I fully depreciated by 40% each year, excluding the first year, which is partial, I arrive at $133,800. Now you'll remember that we only want to depreciate up to $126,000 because we want to stop at the salvage value. So this last year, the depreciation is too high. So we're going to need to plug that amount with $3,000 to arrive at the $126,000. So you have to have a method to stop depreciating an asset when you reach the depreciable base of $126,000. So the first year then is $25,000. That's a partial year. But if you look at the full years, you can see that there is a definite decrease in depreciation as you move through the life of the asset.